Great. Well, good afternoon, everybody. Let me bring you to order with my grateful thanks to all of you for finding your way here. I very much hope that you've enjoyed your tour of the Bretton Woods infrastructure and campus here at the heart of Washington, D.C. This session now brings us to the conclusion of our formal program for this year's Global Parliamentary Forum. We have two follow-on round tables from this, one where we look at economic prospects in Africa, and one where we look at economic prospects in the Middle East and North Africa. And then I'm delighted that this afternoon we will also have our session for young parliamentarians as well. So one of the goals that we have in the Parliamentary Network is to help make sure that you have the facts to steer by, the facts that help inform policy. So the role of this session is really to make sure that you're equipped with the kind of information, the kind of analysis, the kind of data from the very top of the World Bank and the International Monetary Fund. And so it's a real pleasure for me to be able to introduce to you this afternoon Indrek Gill, who is the Senior Vice President and Chief Economist here at the World Bank Group, and Daniel Lee, who is the Division Chief of World Economic Studies here at the International Monetary Fund. And then we're going to hear a couple of perspectives from our parliamentary colleagues. And then, as ever, we'll throw it open to you to raise your questions, thoughts, comments. And I think what we'll do is we'll do that quick fire round as well. So we'll get everybody's voice heard, get all the points of view on the table, and then I'll let our heroic panel try and deal with as many of the points as possible. So thanks again for being here. Thanks again for making the last 2 days such a tremendous success. And without further ado, let me hand the floor, I think, to Indrek Gill, who's going to kick us off. Or actually, Daniel, you'd like to open the polling. Yes. Over to you, Daniel. Thanks so much for joining us.
Thank you very much. Okay, good afternoon, everybody. It's really my pleasure to be with you. And let me give you a summary of the main messages coming from the World Economic Outlook. This is the IMF's flagship report with projections, which we just published this morning, and you can look at the details there online. But let me give you a sense of the forces shaping the world economic outlook, the latest forecasts, the risks that we see, and then some of the policy challenges. The title is A Rocky Recovery, because the world economy is still recovering from the pandemic and from the shock of the war in Ukraine. And what you see here is that until a few months ago, the world economy was actually starting to really perk up. And we saw manufacturing, services indicators all indicating an expansion. But then what happened was that there was financial stress. And a lot of stock markets fell in March, especially for banks. The failure of a number of banks in the United States and Switzerland. This has created tightening in credit conditions, and this is putting at risk this recovery, what was happening. What is happening is that interest rates have been jacked up very firmly over the last year, as you know, at an unprecedented rate. Around the world. And this is coming as a shock because for many years, banks, households, firms were used to low interest rates, low inflation. And this is having these knock-on effects. And luckily, the authorities stepped in very powerfully, put in the liquidity, the depository insurance, and stabilized the situation, prevented it from spreading. And so that is allowing them to continue focusing on one of the central problems, which is that inflation is still high. It's coming down because, as you know, oil prices, fuel prices have started to finally come down. But if you look beyond the fuel and energy volatile prices, underlying pressure is still very high. It's really plateauing of core inflation rather than coming down so far. And so interest rates are expected to continue to go up in several cases. This is cooling mortgage markets, it's cooling demand, and really pulling down. It's necessary, but it's painful. One of the most acute effects of this is on poorer countries. The chart here shows you the borrowing costs, which has really surged. This is measured by spreads over the borrowing costs of countries like Germany and the US. If you look at the right, the colored bars there for sub-Saharan Africa, these are very high spreads that they have to pay. And this is making the problem of debt very hard to bear. You can see on the right that debt is on an upward trajectory. It jumped up during the COVID when governments protected their populations, including in lower income countries. We're at a level of debt that has not been seen in many years. The bright spot is that in Asia, there is a rising economic activity. China, after a very low growth year in 2022, has opened up, and this is really showing up in the indicators now. You can see it from holiday bookings, travel bookings, retail spending, mobility as measured by mobile phones. This is back to normal, and it's having a knock-on effect. A lot of countries export. Look at that, 25% of countries in Asia, 25% of their exports end up in China. So when China rises, this is lifting a lot of the boats. Now, those are the forces. What about the latest forecasts? Our forecast for the world economy is on the left. The black line is the world growth, which is coming down from 3.4% growth in 2022 down to 2.8% this year. So 2023 is the slowdown year. Hopefully, our forecasts suggest that next year there will be a gradual recovery back towards 3% growth. The slowdown in the blue line, that's advanced economies, is particularly sharp. We've got growth in advanced economies halving this year. 2.7% last year, 1.3% this year. The right hand shows you the consequences. Unemployment. Unemployment is really going up. For example, in the US, right now, 3.5% unemployment. We think that's going to go up to 5.2% by 2024. This is part of that cooling from the monetary tightening. Inflation, on the left, you can see our forecast for headline inflation, which includes everything, which is on a steady downward path. On the right, though, you can see underlying inflation, which is basically plateauing this 2023, and we don't expect inflations to get back to target until 2025 for most countries. All right, so this is way to go still. And in terms of that medium term, another theme here is what's going to happen to income growth over the long run. If you took a forecast for 5 years in the future, so for example now 2028, that's a forecast of 3% for the world economy. I've gone back all the way to 1990, the spring of 1990 WEO. It's never been this low. 3% growth. Look at that. In 2008, when we did our WEO, the 5-year ahead forecast was almost 5%. So we've gone from 5% medium term to 3%. The long run is not what it used to be. And this is reflecting some positive things, but negative ones too. The positive ones are that countries have been catching up. Okay, look at Korea. That's an amazing success story. But as Korea has got richer, its growth rate has naturally come down. China as well. And countries around the world have been catching up. This is coming with slower growth. Also, populations are growing less quickly. So the lower productivity per worker multiplied by fewer workers coming into the workforce. So this is basically a slower speed limit for the world economy. To quote the name of our World Bank colleagues have just put out a book which also emphasizes lower speed limits for the world economy. So you can see that there's consensus here that there's much lower growth to come. The less favorable reasons for this slower growth, what are they? The pace of reforms that enhance potential output is really slowing down. Countries have, in a sense, picked the hanging fruit, opening up their trade, globalization. That's not going to be at the same pace. And also, a more sinister aspect, which is this splitting up of economies that had been integrated into different geopolitical blocks, the China bloc, the US bloc. We just put out a chapter in our report focusing on the FDI, foreign direct investment. Foreign direct investment is already splitting into the different blocks. Countries are investing in the other countries in their spheres. That's not necessarily the most efficient way of investing. And we measure the cost for the world economy at about 2% over the long run, just from that. And then there's other costs of the world economy splitting up. So that's on the main outlook. What about the risks? The risks now are firmly, unfortunately, to the downside. Things could get a lot more worse than better. And you can see that very clearly on the left. This is our fan chart for the distribution of likely outcomes for the next few years. It's firmly skewed downwards. Let me give you an example. I mentioned our growth forecast is 2.8%. Well, the likelihood of having growth fall below 2% is about 1 in 4. And something like that has only happened 5 times in the last 50 years. So this is an abnormally high risk of something getting much worse than we expect. And on inflation, the risks are skewed upwards. Inflation could be more and more stubborn, requiring higher interest rate increases. The number one risk right now to the short term, more bank sector stress. We see the situation currently as contained, and central banks can focus on fighting inflation, but there could be a downside credit crunch scenario where they need to refocus more on the financial sector stability. That's luckily not our baseline, but it's one of the main risks that we are focusing on right now. Another one is stickier inflation. I mentioned that. Labor markets are still super tight. Even at this stage, it's a bit surprising. In the US, for example, there's almost 2 job openings for every unemployed worker. Usually it's less than 1 opening per unemployed worker. This is a very tight market. It could lead to higher wage inflation and really make the fight against inflation last a lot longer. Sovereign debt distress, that's another risk. I'll come to that in a moment. So let me move to this central policy challenge now, which is bringing inflation under control. A lot of people ask, well, isn't it time for the Federal Reserve, for example, or other central banks to ease up and cut interest rates now? The issue is that there's been a historical case where in the early 1980s, there was an increase in unemployment in the US, and the Fed cut interest rates, and it ended up being premature. Inflation then stayed high. People started to think this was normal. And then it was very hard work to bring inflation down, much more painful for the whole world. It caused debt crises. That's our advice, to stay steady monetary policy. Steady, but ready. Ready to intervene as they've shown that they can, the central banks in the financial sector if necessary. Fiscal policy can also play an important role in bringing inflation down under control. Don't expand the budget deficit at this time. Don't pour more money on the inflation problem. Actually tighten the belt gradually. That will help central banks avoid to increase interest rates as much. It will share the burden of controlling inflation. Now, I want to spend a bit more time on this sovereign debt problem, which is illustrated on the left. Almost 60% of lower income countries now are facing debt distress, or are already there, which means basically default, which is a very painful shock to the economy. 25% of emerging markets are also facing that situation. This is a very, it's a problem that requires coordination. So that's why we're very supportive of the G20 Common Framework, which you have probably heard of, trying to get all of the creditors to agree on writing down some of these debts which are unsustainable. On the right, you see that in the past there have been some successful cases of reducing debt significantly in low-income countries facing the pressure. It's usually it's required face value cuts in the debt. And that, combined with reforms that stimulate growth, can reduce the debt to GDP ratio effectively. Last point is on the challenge of limiting the costs of fragmentation. The fragmentation is already happening. You can see here, FDI more and more concentrated in the different blocks. Trade barriers successively going up on everything from exports of food through technology. And this is really very costly for the world economy. And what our message is that the policymakers, when they are deciding weighing their strategic considerations, to also look at the cost side. We're trying to inform that debate so that we minimize the costs of this process. Lifting trade restrictions would be something that countries can work together and would reduce food insecurity as well. So there's a number of areas of common interest, and our hope is that this is something that meetings like these can also contribute to in a small way to advancing. So thanks very much.
That was a message both of clarity and sobriety. So thank you for laying it out with such force and clearness. Indra, over to you.
Let me stand and do this so that I can. Okay, so I really like that presentation very much, Daniel. Thank you very much for that. And the way that I would summarize what Daniel said would be sort of 3 points, right? So the first point is that the resilience that we were seeing in the global economy so far, especially earlier this year, we don't expect it to last, right? So global economic activity is projected to slow down, and inflation pressures will persist, and monetary tightening to restore price stability is expected to actually weigh quite heavily on growth, right? And the banking sector stress that you sort of see in advanced economies is also expected to actually dampen activities because this will lead to tighter credit conditions, right? So all of this means the following. It means that growth is likely to decelerate during the second half of this year, and that weakness is expected to last into next year, right? So bad news. Then the second bit of bad news is that even this bad outlook is actually subject to some really high risks, right? So for example, if you end up having banking turmoil that leads not just to the failure of one or two banks, but it becomes a systemic problem, that could lead to a protracted economic downturn, right? The other is that if the higher than expected global inflation, if it persists, or if there are repeated commodity market disruptions because of war or because of other things, this would mean worse things, right? And then finally, so all of this will actually lead to, again, inflationary pressures, and since those have to be contained, it would mean greater monetary policy tightening, and that could potentially lead to even greater financial sector stress. So you have this wide range of risks, which actually clouds even that, fairly pessimistic outlook, right? The third problem, and this is the problem that actually that has not got as much attention, and it's really good to see that Daniel actually had a slide on this one. A real problem is that because of all these cyclical gyrations, everybody's paying attention to this, right? And what we are missing is that during that the potential growth rate, the growth rate at which a country can grow without igniting inflation, has been slowing down. It was slowing down before to 2019, and it's been slowing down through all of these gyrations, and will continue to slow down. So the growth rate or the growth outlook, the longer term growth outlook, which you can easily miss in all of these things, is actually getting worse and worse and worse. So right, and that's something that Ayhan, who's over there, I think somewhere, there he is. So he and his co-authors actually, they have just launched a report called "Falling Long-Term Growth Prospects." He is not very subtle about titles. That says that global potential growth rate is going to slump to a 3-decade low by 2030. So between 2023 and 2030, so average global potential growth rate is going to be 1/3 lower than what we had got used to. Okay. And this slowdown is going to happen in rich countries, in middle-income countries, in low-income countries, is going to likely be the greatest in middle-income countries. And since close to 75% of people who now live in middle-income countries, or close to 75%, it's a large part of the world, right? Now, why should we care about this, right? We care about this because growth is central to a lot of things, right? So growth is central to eliminating extreme poverty, towards creating jobs that we all care about, and that leads to social stability, which means more progress, right? And also, you hear a lot about climate action, but you can't have climate action unless you have resources, and you can't have resources unless you have growth, right? So for all of these reasons, it's really important to actually do whatever we can to turn this around, to actually start to see. All right, so how do we turn this around? And the best way to think about turning this around is, we have got used to China. The reason why everybody started to get optimistic in January and so on was because, as Daniel said, China opened up. And we are so used to China just sort of pulling the rest of the global economy along that we said, great, China's opened up, things are fine again, okay? But China is going to slow down because it is getting more and more prosperous. China's trade as a share of its GDP will also go down because it's getting more and more prosperous. So in some sense, we have to start to get out of this habit of just relying on China to actually pull us out of this, right? But China is a big country. It's been a very dynamic country and so on. So where are we going to find another China, right? And I think the short answer to this is we're going to have to create China in the aggregate, okay? So we're going to have to sort of find that extra 1 percentage point of growth in a lot of countries. And if you sort of did that enough, so you go down the list. I was thinking about all the countries, right? So you have in Asia, you have India, you have Indonesia, you have Vietnam, you have Bangladesh. Okay, each one grows a little bit more, right? Brazil, Mexico, Peru, and then you have countries like Turkey, Poland, Kazakhstan, and perhaps even Russia. And then you go to Africa and you have Nigeria, South Africa, Angola, Kenya, you have Egypt, Iran, Algeria, Saudi Arabia, so on, right? So you have to create a China in the aggregate again. Now, if you sort of actually look at this and look at all of these countries and you say, can they grow at another percentage point more so that, instead of growing at the 3% that we are projecting, they grow at 4%, instead of 5% that we are projecting, they grow at 6%, and so on, it can be done, right? And so you say, okay, how can this be done? Of course, it depends on each country and so on, but there are sort of 2 or 3 things that one can keep in mind about this. The first thing is that we have to help countries stay out of debt distress. Because as Daniel said, so he said it very kindly, he said that we have a common framework that really works to help he's being too nice. It's not working. But I think the important thing to understand is that it is critical for countries to stay out of debt distress because we don't have a good mechanism for resolving debt distress. So if you're sort of thinking about skirting close to fiscal sustainability and so on, you should encourage your countries not to do it because the risk of things, once a country goes into debt distress, take a look at Zambia. Zambia was a middle-income country when it went into debt default. Very bad things start to happen to countries like this. So the exchange rate depreciates, the investment rates falls, growth comes to a standstill, sometimes goes into reverse. Per capita incomes start to fall. Poverty rates start to rise. You have political instability, social instability. Zambia started out as a middle-income country. Today, it is a low-income country by our standards. You see the same story in Sri Lanka. It started out as an upper middle-income country. But because of the debt distress and so on, because of the fact that you can't easily find these resolution mechanisms for it, they just slip. You lose years of growth, right? So Sri Lanka now is a lower middle-income country, so it slipped again. And this story you see over and over again. So I completely agree with Daniel that it's really important to stay out of debt distress. It's important to sort of make sure that not just stay out of debt distress, but high debt levels, which you can sustain if you really try, they can start to cramp on growth very, very quickly. So even before you get into debt distress, debt levels actually start to slow down your growth. They start to slow down your growth rate. I was just listening to the finance minister of Jamaica, and he was saying exactly this thing. He was saying that they had very high levels of debt to stress. They had very high levels of debt, and this was preventing them from actually responding quickly to emergencies like climate shocks and so on. And it was keeping them from making investments in education, health, and so on. So they had to bring that down in order to become more resilient and to grow and so on. So that's the first thing. The second thing that you sort of see is many of the countries, especially the countries in South Asia, South Asia as well as the Middle East and Sub-Saharan Africa, you find that they have this huge pool of unused human capital. And it's basically, you have educated women who are not in the labor force. Okay? Many of them want to be in the labor force, as you sort of see in India, for example. You have higher unemployment rates for women. Okay? India's female labor force participation rate is 1/3 that of China. So I always sort of say is that, look, do you want to catch up to China? You can't catch up to China hopping on one leg. Okay? China has a female labor force participation rate of close to 70%. India's is less than 30%. You're closer to 25%, right? The same thing is true in Turkey, in Jordan, in a whole lot of other places. So that's the other. So there's this pool of human capital, right? Then there's a pool of capital, of financial capital that everybody talks about, and they say that you have all of these savings in advanced economies in the richer countries. So I think in some ways, I think that developing countries have to create the condition where this capital starts to come. And then as a result of that, you will start to get growth. And as a result of that, you'll get that additional 1%, 2%, and so on. And you'll create China in the aggregate again. Okay? So I'll stop there and take your questions. But we have the report. We don't, I don't think that we have copies of the report. But if you, I think that on your way out, you'll be able to get a pamphlet where we have. There is a lot of work done by Ayhan and his colleagues, and I would really encourage you to look at that.
Thank you so much. So now you see why when we were writing the concept note for this forum, we called it Tougher Challenges, Tougher Choices. But thank you both for taking us on an emotional roller coaster of both a low and then a high by providing some solutions as well. Right, just to open our parliamentarians' reflections then, we're going to go to Kwasong, who's the chair of the Finance Committee in Ghana, and then we're going to hear from Jigme Wangchuk, chair of the Economic Affairs Committee in Bhutan. But Mr. Kwasong, over to you.
Well, thank you very much. My name is Kweku Kwati. I'm a member of parliament in Ghana. Listening to the not too pleasant outlook, I'll try to look at how the recovery for those of us from developing countries should look like, given the kind of outlook that we just have been briefed of. But it will be helpful before we look at even that to look at how African, and perhaps not just African, but we in developing economies, how our economies were before COVID. What exactly did our economies look like before COVID made it worse, as a result of which we're having to discuss the recovery? Fact is, for many of us in developing economies, we had been registering and reporting deficits almost as a way of life. Every year, we overspend our budgets, and then the way we finance that gap is to borrow to finance the current gap, but also to service the debts for previous years. And then the subsequent year, we still overspend, so we need to borrow more, use a part of that debt to finance the current year over expenditures, but also to service the debt from previous. So we have been running our economies almost like some kind of Ponzi scheme. We never paused to ask ourselves, so where are we going? Where is this all going to end? And borrowing to finance both capital and recurrent expenditure had become a way of life for many of our economies. So if you look carefully, even before COVID, the threat of macroeconomic instability had always been lurking visibly beneath. And for many of us, it had become manifest. That is a reality. So COVID only came, as we have been reminded of several times, COVID only came to worsen a not too pleasant situation. And to put it in another way, COVID, in my view, came to remind those of us in developing economies that we didn't have time. And the earlier we set about to fix this weakness, this fundamental weakness in the way we have managed our economies, the better it will be for us. When I look at the outlook, I don't get a sense that people would come from elsewhere to help us. Everybody is minding their own issues. Of course, we are part of the global economy and we have our development partners, but the fact remains that our salvation would rest in our own hands. So, what should be done? I think the first source of action should come from our governments. We should take advantage of the general sense that things are tough to convince our populations that spending money we do not have on public projects can no more continue. And that it is in our own interest and in the interest of the future of our economies that we begin to spend within our means. You don't gain if for some years you were minded to overspend your means in order to build a certain capital with which you'll be able to generate more revenue and to finance the debt that you took, that would make sense. But where it is becoming a way of life, that we're borrowing year after year to finance both recurrent and capital expenditure, we should know that is not the way to go. And we should take advantage of the current environment to tell our people that the outlook is gloomy and going forward, that cannot be an option. But I think in doing this, especially for those of us in politics, we should lead by example. We should spend less on ourselves as political leaders and send a clear message to our people that we are in this together. In many countries, it is so difficult to push the discussion about cutting public expenditure to live within our means, because they're always telling those of us, I'm a member of parliament, and so I'm clear in my mind what I'm saying. They are always quick to point to the things we political leaders are doing wrong, as a result of which you find it difficult then to do the reforms that are needed to ensure that in the long run you can stabilize our economies. My summary on that is that we should show our own people that we are in this together. And there must be clear evidence that will make people, for many of us in our countries, politicians are not the most trusted people. It is not just in developing countries with developing economies. I think it's part of human nature. But if you look at countries where the standard of living is quite good, citizens don't feel as badly as they do in countries where you can still stark poverty and you can see people suffering. That's my favorite point. As political leaders, we should begin to lead by example. And then I also think that the fiscal cannot just be tackled by looking at the expenditure side. Of course, we should look to spend within our means, but I also think we should step up our efforts to mobilize domestic revenue. We should step up. In many of our countries, you have very powerful people not paying taxes, and we do not have the revenue mobilization infrastructure to get everybody to pay their fair share of the taxes, and so we definitely are collecting less than we should. I think it is time to look at that as well. And maybe in this regard, since I'm from Ghana, we need to commend the Ghana government for its current reforms of its exemptions regime, where big business and powerful people in the past were not paying taxes in the name of tax exemption for investment promotion. Government is taking steps to correct that. I think we should stay the course. I know the powerful forces against these reforms. We should stay the course and ensure that everybody would pay their part of the taxes. And then I'll finish shortly. The next source of action should be our development partners. Of course, I have already made a point that our salvation lies in our own hands, but I think our development partners have a role to play. It is not for nothing that we came together to form these institutions, so we help each other. And I think first and foremost, especially where we are now, most developing economies will have difficulty getting out of whatever COVID and the Russian-Ukraine war have brought without some debt relief. And I speak of Ghana as an example. Without debt relief, I'm just hoping that as a result of what is happening, we all come to the realization that things have to happen differently. But it's entirely possible to come to that realization, and yet, because of the burden of debt, you just cannot get out of this. And I think at this point, debt relief is more necessary now than ever. I heard a message yesterday that the nature of our debts, unlike in the past where HIPIC was easy because it was largely multilateral debt, now you have a lot of private investors in there, so it becomes difficult. I still think that if there's a commitment to do it on the part of our development partners, we will be able to influence other creditors to also see the case for these developing economies. So that's the first thing I think our development partners could do to support us in developing economies. The second is, my second point is premised on the fact that, governments, and since I'm focusing on developing economies, government in developing economies finance their budget overruns through borrowing. There's no other way of doing so. Now, our development partners in the past, it seems to me, have been very diplomatic about exposing governments whose borrowings have obviously become unsustainable. And there's always a way of letting it look like the countries are doing their best. And I think we should call out governments that overspend. It is clear, you can look at our budgets, it's always clear. Our DPs should call out governments that are borrowing more than they should, so that the investors who make monies available to finance these budget overruns would know that they're putting their money in very risky places. Finally, I think the point of that was to call on our development partners to make it more difficult for reckless governments to get access to lending. Finally, and I take this in 1 minute, I think it should come to we the parliamentarians. We get to parliament because our people like us. We may not necessarily be people with the understanding, and fiscal understanding of government policies. It's important that we upgrade ourselves in order to be able to understand the fiscal implication of government policies, so that when our governments bring the request for policy approval and expenditure approvals, we'll be able to understand the fiscal implication and tell government that no, we are not going to do this because we've been doing this for so long, it has been unhelpful. So in the end, I guess think that in this period of recovery for we in developing economies and giving the outlook that we have been shown, I think we should do things differently. And we, the parliamentarians and our parliaments, should be holding the whip. I thank you very much.
Great. You can let me hand it straight over to you. Floor is yours.
Good afternoon, ladies and gentlemen. I take this opportunity to thank, first of all, the Chair, IMF, World Bank for bringing us all today in this forum. So first of all, let me introduce myself. I am Jigme Wangchu, and also I'll introduce my country. As you all may not know where I come from. I am from Bhutan. Bhutan is a tiny nation in between China and India with a less than 1 million population. So I represent Bhutan here. So I am a member of parliament and presently serving as a deputy chairperson in the National Council of Bhutan, one of the houses of parliament in Bhutan. So today I'm so honored to take part in this Global Parliamentary Forum, which is taking place in person after 4 years. And I had a great opportunity to take part even in 2019 in this, I think in World Bank building. So today's topic, which was given to me, World Economic Updates, where we stand. So basically, I don't have a data, I don't have a technical term, just I will present what as a parliamentarian we played role to resolve this issue in my country. The importance of this forum, as you all are aware, lies in overarching the theme, tough challenges, tougher choices, which generally focuses on the multiple crises facing on our common humanity, including climate change, security, governance, accountability, growth, debt, gender, and cross-border migration. In particular, the session World Economic Update, Where Do We Stand? Provided us an update on the latest global outlook on the world economy and how will the economic outlook for 2023 shape a world of tougher challenges and tougher trade-offs. Given that countries are still dealing with COVID-19 crisis and the fact that climate change continues to have serious effect where poverty is rising and low-income developing countries are having economic crisis. Therefore, it is imperative that serious discussion on the pertaining topics and resolutions and recommendations from the forum sessions are effectively implemented by the countries to address the issue. Against the backdrop of the depending crisis in the food, fragility, finance, and the fast rise in extreme poverty in this century, the Russians' invasion of Ukraine, the seven giants, want, hunger, diseases, loss, earning, conflict, debt, and climate change now stand in the way of low and middle income countries meeting the sustainable development goals and climate target as pointed by the Bridgetown initiatives. Therefore, as a cardinal institution of democracy, parliaments have an important role to make SDGs a success, and therefore realistic steps need to be taken, advanced integration of SDGs in our country's national and local level policies, programs, and also to monitor the implementation progress. We must ensure that the voice of the parliamentarians elected to serve the people is heard in the debates of GPF. Given the similarities between Bhutan's development philosophy, gross national happiness, and SDGs, both aspiring to pursue sustainable economic development path, alignment of SDGs in our 5-year plan does not pose a challenge. We must ensure significant engagement of the Parliament on SDGs by consolidating the National Development Goal and SDGs. By bringing SDGs in the parliamentary mainstream, it would help institutionalize parliamentary effort towards social equity, women's empowerment, and good governance, which form the basic of democracy in Bhutan. The 3 pillars of SDG, economy, society, and environment, were included under the 4 pillars of gross national happiness in my country. They are good governance, sustainable economic development, preservation and promotion of culture, and environment conservation. Despite the impact of COVID-19, Bhutan is on the track to graduate later in this year, in 2023, from LDC. As an important step that Bhutan needs to undertake towards graduation is the formulation of the next development plan to incorporate recommendation of smooth formulation of the next development plans to incorporate recommendation of smooth planned transition strategies, STS, after Bhutan's graduation. STS will strengthen the country's pursuit of sustainable development priorities, the 2030 development agendas, as well as address the phasing out of LDC associated international support measures. Therefore, the proposal of reforms presented to the World Bank, which falls in 3 categories. They are mission, model, money for the global development finance system needs to be effectively implemented and resource adequately mobilized, especially for the low and middle income countries. In conclusion, it's my firm belief that outcome of debates and discussion of the forum will achieve the desired results and pave a way to tackle the most crucial development challenges facing the world. I would like to express my sincere gratitude to the Parliament Network, on the World Bank and the International Monetary Fund for extending the invitation to participate in the Global Parliamentary Forum this year. Thank you very much.
Right, I'm about to open the floor to questions. We just have one very quick video from Eurida Tabuku, who is the chair of the European Affairs Committee in Albania. I think this is just a short message, but let's have that now.
Dear Honorable Björn, dear friends of the Global Parliamentary Forum of the World Bank and IMF, greetings from Tirana. It has been more than a year since Russia started unprovoked aggression towards Ukraine. This has triggered a humanitarian crisis, but also has stopped our countries for sustainable development. This has created disruption in the supply chain and reawakened inflation. In Albania, the situation is a little bit more precarious, because there is a different structure of the economy, but also high inequality and a very high pressure of the debt on the budget, but also national expenditures. Inflation has hit hard family income. Every Albanian family spends 41% of its total income on basic food, and with the core inflation being highest in the region, but also with a very weak economic growth of 2.2%, the prospect is grim. 1 in 3 Albanians, according to the World Bank, spends less than $5 per day, which is the poverty line. All this does not come as a surprise, as the budget has prioritized concessions and PPPs, creating a very high risk on the budget, but also considering the threat that is coming from high energy prices, but also migration. Yes, migration is a real threat to the Albanian economy, because even though we have the highest investment in young people and the lowest average age in the region, we are lacking the skilled and professional people who are unfortunately leaving the country. The lack of market economy, the social mobility, and the high level of corruption are the main reasons for it. This will impact our economy in the next 5 years. Therefore, we need to take bold action now and to save our citizens and engage in structural reforms, as minimizing the cost of corruption on the budget from one side, but also focusing on education and health from the other side by investing and not forgetting the two main contributors in the GDP, which is tourism and agriculture. The government should do whatever it takes to reduce the risk of increased instability, but also increased insecurity. Innovation doesn't build from itself. It needs focus, it needs investment on education, but also it needs some free market to operate, but also to help these businesses in the area grow. Albania should be able to attract foreign direct investments that create value to the economy and not cost to the budget. Energy and diversification of energy is a great example because this country has a huge potential in it. As we are heading towards a very stormy phase of the world economic outlook, we need to prepare ourselves to be side by side with our friends and partners. For this reason, the new $900 million World Bank support should be focused on digitalization, infrastructure, fiscal policy, but what is most important in the human capital, and to promote strategies to foster employment. Investing in people should be key for our future. Dealing with migration now is a priority, and making the fight against corruption a national priority should be the main focuses. Thank you to all, and I hope to see you in the next session.
Excellent. Great. So, echoes some common themes from our sessions. Right. Let me open it up. Let me just see an indicative show of hands, which will help me calibrate. Great. Right. I'm going to just start over here and work that way. Yes. You. Yes. Yeah, please.
Where's the mic? Greg McLean, I'm a member of Parliament from Canada. For the last 2 days, I've heard a lot of talk here at these sessions, and I've spoken to a lot of the delegates here as well. Thank you for all your input, everybody here, and thank you as well for your presentations. They're very succinct. Let me say that in 1980s, the world went through a similar situation where governments were overspending all across the world. To get a hold of that, of course, they raised interest rates. What did that do? That caused a whole bunch of debt overspending, the higher debt service costs in developed countries around the world. That caused a decade of negative growth in developing countries. That was a lesson. What that accomplished was lowering the price of energy for the developed world. So the developed world did okay at that point in time, and they got ahead of inflation because the number one factor that correlates is cheap energy. So cheap energy got the developed world out of that at the expense of the developing world. And that's the path we seem we're on again here. We continue to have, in this period, Western governments, advanced economy governments, that are running excessive deficits. The United States has another $31 trillion in debt. Canada just run another $41 billion deficit for the coming year. That starves the developing world of financing in order to get their projects done. Now, this is the message I think you need to take to developed world's governments, is stop overspending. Get back to balanced budget. Like Mr. Kwarteng said, get back to balanced budget in the developed world so that there's money available in the developing world that they don't have to pay a premium to get a hold of here. Now, you also talked, Mr. Gill.
Just really quickly, because we've got.
So you talked about savings in the Western world. Those savings are in pensions. Once you start talking about putting pensions at risk, the whole thing falls down in the Western world. Pensions go under, insurance companies go under. Let's get banks back to being banks and stop paying attention to peripheral things that regulators should be paying attention to. Thank you.
Yeah, perfect. Thank you so much. There was someone else with their hand up. Yeah, please.
Does it?
Yeah, you're good.
I'm Chema Guijarro. I'm Spanish MP. I've been also assisting over these past 2 days to these debates. So first of all, thank you very much. But anyhow, I would like to stress that I've been hearing over these past couple of days, diagnosis, which, I mean, we're quite sure that we can all agree, right? And we're quite clear that it's new challenges, colossal challenges, but I still keep listening old answers. It's kind of you know, a bit, let's say, I don't want to be a pessimistic, but I thought I would have had some kind of new answers to new challenges, right? So is it possible that these institutions, the Bretton Woods institutions, start thinking on new answers to new challenges? Because, you know, I don't want to be, well, it's kind of obvious that it's ironic.
You've actually given us the title of the next Global Parliamentary Forum, I think.
Okay, so you're welcome then.
That's it.
That's my comment.
Yeah,
that's,
perfect.
that's
Okay,
sure.
appreciate
Thank you
that.
very
Thank you. Right, did I see a couple of others yet? Can I just go to the front here? And then I'm going to come that way. Yeah.
Thank you very much. Thank you very much. My name is Fred from Uganda. We've listened to tougher times starting yesterday, and today it seems things are getting out of hand. I just want to ask a few questions. The solutions seem to be with us also, and we want to request for your guidance and support. We are looking at circumstances where at times borrowing that we see in some of our countries is for consumption. How do you help us now focus on borrowing that should spur development? Because we look at some of the facilities that you give us, at times wasteful. And we as parliamentarians, you know, we've been trying to raise this concern that we are not many times involved in all the processes. At the tail end, when we look at these processes that have taken place, we see some of the facilities that you give us are for consumption. And I think this is not good. Help us in that line. But also now, we have frustrations of improving our tax base. And we need you to support us in this. How can you help us build our capacities to widen our tax bases within our countries in order to see how to grow our GDP to tax at least over 20%? Yeah. We need to look at that. Give us those solutions. Then also we have challenges of subsidies and exemptions. Yeah. We are at times gagged by FDIs, the foreign direct investments that come with the request to our nations to give them exemptions, and also some subsidies that keep coming up. Yeah. How can you help us to align on that? Send us FDIs who can give us value other than those who again come and request for exemptions and force us into subsidies. Then at the end of the day, we are not able to move.
Let me stop you there, just because I've got a couple more to get in. No, come on. Yeah, just one sentence.
Debt relief. We are asking for debt relief. It may help us.
That's brilliant. Okay. I just want to take a couple in because Indra, it's got to go in a minute. So let me just take Tanzania at the back. I'm going to come to others, but I'm just going to come to Indra. Yeah. Hello. At the back. Sorry, I was going to go to Nima from Tanzania at the back.
Thank you very much. I'm Nema Lugangira, Member of Parliament from Tanzania, and Chair of the Tanzania chapter of the Parliamentary Network on World Bank and IMF. The World Bank is going through an evolution because it's recognized that global challenges need global solutions. So I just want to ask the IMF, is the IMF going to remain country-led, or is the IMF also going to go through a similar evolution? Thank you.
Hello? Hello? My name is Celestino Chumpi. I am parliamentarian from Ecuador. I like to speak only English, but my English is very limited. Now I speak only Spanish. I have a question.
In Ecuador, we, the native peoples, we live in the Amazon region, which is very rich in resources, but we want to prevent further pollution. But there are so many oil and mining concessions that are impacting our Amazon territories in Ecuador. We know that in our country, there is borrowing and more borrowing. But my question is, to what extent is Ecuador in debt distress from the perspective of the IMF or the World Bank? That's my question. Thank you.
Go in a second, then I'll come back out for another round.
We can take 2 more questions. And then, yeah.
Yes.
I know he's telling me to leave, but I would like to hear. These are very good questions.
Merci beaucoup.
Thank you very much. My name is Ayel, and I'm a member of Parliament of Guinea. I would like to congratulate this group of speakers, all the speakers. And my question today on this theme relates specifically to increased investment. Is there a real desire on the part of the IMF and the World Bank to step up investment in Africa, and especially in East Africa? Why? Because in looking at the World Economic Outlook today, it revolves around the energy challenges. But what energy sources? Clean sources of energy. So this relates not only to the anticipated energy transition, but we also know that there are critical minerals that are found in this region of Africa, with the Great Lakes region and the Western Africa. We have a metal that graphite, precisely, that comes into the composition of batteries together with lithium and cobalt. So my question is, what are the intentions of the World Bank and the IMF in terms of measures to step up investments in this region so that a real value chain can be developed? Because oftentimes minerals are being developed in these regions, but there's no processing and transformation of these raw materials to create added value on site and to help generate revenue from this development. And if we keep carrying on with the same policies, which still deliver the same effects, it will be difficult, truly difficult, to create a balanced approach and ensure sustained growth in this region. Thank you.
Yeah, no, these are excellent questions, and it's very hard to answer all of them. But the one that I thought that I will try to answer very quickly, and I'll leave the easy ones to my colleague from the front, was that, that what is, that why are we coming up with old things, that we keep. Well, so if you think about the last 25 years between 1990 and 2015, these were the golden years of international development. There was so much progress. These are the best 2 decades in these were the best 2 decades in the history of many countries, right? So then you start to sort of say, okay, what is it that actually led to this? And if you strip it down, what you find is that the first thing was that these countries all decided that macroeconomic stability was very important. Okay? On the fiscal side, don't overspend. On the monetary side, don't print too much money, because this leads to inflation. It hurts everybody, it especially hurts the poor. It leads to less entrepreneurship, etc. The second thing they say was, you realize that you don't want the public sector to be leading that you want the private sector to be leading the economy. So you want to create the environment in which private investment takes place. And somebody else asked the question about, that you will get flows of money that will finance consumption. That happened in Greece, for example, okay? But when you create a good investment climate, that money will come, but it will go into investment. It won't just go to consumption. The difference is that the money that comes in for consumption leaves very quickly as soon as things turn bad. It leaves very quickly. The money that comes for investment is there for the long period. So that's the second thing, a good investment plan. The third thing was that you have to have, so with these two things, what happens is that even poor countries, there's a big supply response. But countries become producers before they become consumers when they do things right. So these goods and services have to be sold somewhere else. So you need a good international trade regime, right? Now, if I had to answer your question, I would say, I think that we forgot that these three things are very, very important. I think advanced economies forgot it. I think developing countries forgot it too, okay? Now, some of it is not forgetting, some of it is changing a thing, but these are the three things that you have to recreate in order for us to start to grow again. So I can just imagine now. Now, you're absolutely right that the world has changed a lot, and there are different ways to actually do these things. There's greater digitalization. You can actually have a green economy. You can have all of these things. And we're struggling with those things too. But some of the things do require old answers. You know, we should not forget that you still need macroeconomic stability. You still need a good investment climate for private enterprises. And you still need international trade. So I think, you know, you should want the International Monetary Fund and the World Bank to be working on these things too, while they are also trying to struggle with the new things, right? But even if they just did these old things, I think it would do the world because the innovations of the kind that you're saying, you're seeing those innovations coming up in every part of the world, high-income countries, middle-income countries, low-income countries. But these are excellent, excellent questions. I'm sorry that I can't stay longer.
Perfect. Thank you so much for the time you spent with us.
Thank you,
Appreciate
sir.
it.
Thank you very, very much.
Right, we'll give Indra a little round of applause. Thank you very much. Right, and I'm just going to take a few more questions. Let me go to Marlene, and then let me pick up a few on the other side. I'm not going to get everyone in. Please.
Marlene from Jamaica. You know, as I've been listening, I just want to say that we in the room represent people. People who feel, many of them feel undone by governments. The decision taken do not have impact on them in the way that they would like. And they're left worse off in the aftermath of COVID. So the well-being of the people is of macro criticality. And I think that as we contemplate the spend and the direction and the dialogue with our governments, whatever the decisions are that have to be taken to ensure stability, to reduce the risks, they must have a positive impact on the people. And so I think this is where in the meetings taking place, that has to be at the center of the focus. People feel undone by government. And they feel that when we come to meetings like these, the issues are discussed are over their heads. And there isn't that connect with them. So at the end of the day, whatever it is that we need to know at the macro level, the people must feel it in a positive way at the micro level.
Brilliant.
Amen.
Lady here, and then I'm going to come over there. Yeah, just Molly, just pass the thank you. That's awesome.
I'm Zaitun Swai from Tanzania. Thanks for the rich discussions that we had since the start of the spring meetings. My focus is in the cost of lending, which we had during today's discussion. Most of the borrowings that for us, developing countries, we get from our development partners are in foreign currency, and we are demanded to pay in foreign currency. My question, why don't you remove the restrictions that we have in the loan usage by focusing and helping those developing countries to focus in the productive sectors like agriculture and extractive sectors, in order to mobilize the foreign currencies, to help them balance their accounts of payments, and also to stay away from the debt district. Thank you.
Perfect. Thank you very much. Let me just go to a colleague here and then here. Can we just get a mic here? Please go ahead. Guys, can we get a mic? Thank you.
Thank you much. I'm David Boni, Member of Parliament Kitui, Member of Parliament Kenya. My question is on debt. I've listened to the presenters, and the proposals which they are giving us, to me, they are long-term. Foreign direct investment, increasing foreign direct investments, and fiscal discipline, which most of us countries have not been able to achieve. But as we speak now, the developing countries are in crisis. In fact, very soon, most of our countries will not be able to meet their debt obligations because the revenues, tax revenues have gone down because of low economic activities. You did mention very well that G20...
Just briefly, because I've got one more to get in before the answers. Yeah.
Yes, you did mention that G20 are meeting to discuss how they can forgive the debt to the developing countries. But you have not gone further to tell us how far that one has gone and what is the role of IMF and World Bank on these talks. Thank you very much.
Absolutely cool. Yeah. And the gentleman there. Yeah, South Sudan. No, sorry, just behind you. Colleague behind you, and then I'll get you in as well. Yeah.
Yeah, thank you for the opportunity. My name is Paul Baba from South Sudan. The discussion, I like the discussion, but there are two things I wanted to understand from the partners.
Yeah.
The funding is to a certain group, but so far as the honorable member from Tanzania mentioned, some of this funding has not reached the grassroots as we wanted it to be. We wanted support, like COVID-19 came in. The COVID-19 came in, there came another disaster of environment, the climate change and so on. All this one impact, now the government is stretched to sort certain problems of security, problems, and so we need partners who will come and bail us out of these grassroots challenges we are going through as parliamentarians. We are not able to explain to them what is happening about the inflation, what is happening about this economic crisis. So is there other terms which can be easier for us to be supported in this area? Thank you.
Perfect, thank you. And then finally, colleague at the front.
From Kenya too. I just wanted to know quickly, what policy tools are available, especially for Sub-Saharan Africa, to respond to what we've just spoken about? Because from where we sit, we are worried that we're going to come back to SAPs. We are worried that the World Bank and IMF is going to come back to these countries to introduce the 1990-2000 SAPs, and this will make it difficult for most of us to even afford food. Number two is, is it possible to do to deal with commodity prices, especially food commodities at the global level? How do we deal with that? Thank you.
Perfect. Great. Right, Daniel, draw from that what you will. Not all of those questions you will be able to answer,
Right.
but there will be a few pointers that I think you can give.
Thanks, Liam, and thanks to all for these, very deep questions. Actually, I heard a lot of comments and questions about investment in people, investment to unlock the capital, attract capital, and that there's obstacles in the way, and how to overcome these obstacles. There's the first route that Mr. Kwarteng was talking about, how to avoid getting into a crisis by living in your means. Discipline, yes, that of course is an important part of the solutions. And but at this time, with so many crises really waiting to happen, a lot of risk of debt distress, I think we're going to also need to have an actual debt reduction in some of these cases to be able to unlock the investment. It has to be in the context of a medium-term responsible plan, but the debt is simply too high in some cases to allow these investments in people and so on. And in that context, the question was also about what is the role of the international partners. The fund and the World Bank are very much involved in these informing these discussions with the creditors as part of the G20 framework to help to speed this up, because as Indermit said, this is going way too slowly, and we're just not ready for this important task right now. And an additional point was about the tax system. How can the tax system help to achieve this goal of getting investment into people and so on? And that's another place where the World Bank and the IMF can be accompanying the governments in reforming the tax base to make it, to close the loopholes, to find better ways of incentivizing investment, including in the green transition. So I can see that there's a lot of room for continuing discussion and collaboration. And I thank you for all those comments.
Brilliant.
And with that, I might need to take my leave as well.
Yeah, perfect. Great. Daniel, thank you so much. I'm going to come to you.
I'd like to wait and just make a point about what my colleague from, was it Uganda? You know, the most difficult part of fighting excessive exemptions in our economies, for we developing economies, has been the exemptions that come with development partner support. And the phrase you hear is, you are not allowed to use this money to finance, to pay taxes. Now what that does is to undermine the entire tax exemption regime, and I'm able to say this because Ghana is in the middle of one search, and the most difficult part is where the development partner is giving you support, and they say you can use it to pay taxes, and therefore you would see that you are upsetting the entire tax exemption regime. So we really would need you, as you support, you relieve our debts, as you support us to improve domestic revenue, to also help us ensure that everybody pays their fair share of taxes.
Yeah. I don't know if you want to say a word about that, but I know you've got to exit.
No,
so
you said
yeah,
very well.
Perfect. Daniel, thank you so much.
Let me
lead a round of thanks for you, Daniel. But then, can I just ask my fellow panelists, any final reflections? Any, just in a sentence or two, Kwaku, anything else you want to add? Okay, perfect. Well, look, folks, that brings the kind of the group sessions of this year's Global Parliamentary Forum to a conclusion. We've got 3 more sessions that you're welcome to join. So we're going to have a briefing on the economic outlook for Africa, which is going to be here. We've got a briefing on Middle East and North Africa, which is now actually open to all. So anybody who wants to go along with that, please feel free. And anybody who is lucky enough to be young enough to be a young parliamentarian, we have our young parliamentarian session a little bit later on today. So please feel free to make your way to that. But look, that brings this part of our session, this part of our conclusions, this part of our discussions to a close. It's been a huge pleasure to help chair and put this together. I hope you've got a lot out of it. I'd love you to tell us more about what we can do better to empower you over the days and years ahead. As we can see, they're going to be difficult. But my last duty, if you don't mind, if I can just bring you to order for a moment, my last duty is just to ask all of you to join me in saying a few thanks. First to Kofi and Blythe and Amy and their team, to Tilla and Jim at the IMF. And then please join me in saying a massive thank you to our superb secretariat at the Parliamentary Network based in Paris, Gagana, Philippe Arthur and Pierre-Louis. Thank you for bringing us together with such professionalism and skill. Now, all of you know that when you get home, you are under strict instructions to think hard about how to set up a parliamentary chapter of the Parliamentary Network of the IMF and the World Bank. Just drop me a line by email with an expression of interest and some of the names, and we will take it from there. But finally, let me just say on a personal level, it's been brilliant to have so many people back in what I think has been our biggest Global Parliamentary Forum ever. I hope to see many of you on our annual meetings visit, which will be in Morocco in October. There will be field visits in June. I hope to see some of you then as well. But with that, let me declare this session of the forum closed with my heartfelt thanks to all of you. Thank you.